Continuing to move forward, Chapter 10 talks about corporate governance, notes to the financial statements, and other disclosures. This is where some of the additional meat, being a manager and providing the adequate information, comes into play. Generally, after studying this chapter, you should be able to understand what the significance is of corporate governance, what some types of financial reporting misstatements have that have occurred in recent years, explain why notes are an integral part of the financial statements, discuss the kinds of significant accounting policies that are explained in the notes, describe the nature and content of various notes disclosures, explain the role of the SEC and some of its reporting requirements, explain why a statement of manager's responsibility is included in the notes, describe the significance of the management's discussion and analysis of the firm's financial condition and results of operations, identify what is included in the 5-year or longer summary of financial information, and discuss the meaning and content of the independent auditor's report. So now we're looking at everything else that has to do with the financial statements above and beyond just the numbers. Remember, accounting is the language of business, and with the language of business, there are a lot of different things that come into play. First and foremost is, of course, corporate governance. This includes business ethics, social responsibility, equitable treatment of the shareholders, disclosures, a big word that we use nowadays, which is transparency and is very important, what the board of directors' responsibility is, and some examples of the significance of corporate governance. The most powerful legislation to date has been the Sarbanes-Oxley Act of 2002. You've probably been exposed to this act already, often called SOX. It was created by the Public Company Accounting Oversight Board it created the Public Company Accounting Oversight Board, also known as PCABO, as the authoritative watchdog over accounting and auditing professions. SOX legislation was aimed primarily to curtail the misbehavior of senior management of some corporate entities. These are potentially CEOs and CFOs. And these individuals are now required under SOX to attest in front of a notary to the correctness of their company's financial statements. It has removed their plausible deniability over potential misdeeds. In addition to certifying that the financial statements are in correct order for CEOs and CFOs, registrant also has to report in a separate section of their annual 10K any changes in the disagreements with accountants on accounting and financial disclosures. This is an added measure of transparency and management accountability. Another corporate governance act that really came about to cause some response to the financial crisis of 2007 and 2008 was when Congress passed the Wall Street Reform and Consumer Protection Act of 2010. This is also called the Dodd-Frank Act. Although most of this act deals with financial regulations, several of the provisions impose new corporate governance rules not just on the Wall Street banks, but on Main Street public corporations as well. Dodd-Frank contains the say-on-pay mandate requiring periodic shareholder advisory votes on executive compensation and golden parachute provisions. These are areas where there has been significant likelihood that there is something within it that contributed towards some of the financial shenanigans that have occurred over the last couple of decades. The Dodd-Frank provision requires that companies disclose the reasons that they have chosen to have either the same person or separate people serve as CEO and chairman of the board. There have been some pretty significant financial misstatements in recent years. Those include recording revenue too soon, such as recording revenue before completing the obligations under the contract, recording revenue far in excess of work completed on the contract, recording revenue before the buyer's financial acceptance of the product, recording revenue when the buyer's payment remains uncertain or it's unnecessary. There's been some financial shenanigans that entailed recording bogus revenues, such as recording revenue from transactions that lack economic substance, recording revenue from transactions that lack a reasonable arm's length process, recording revenue on receipts from non-revenue producing transactions, recording revenue from appropriate transactions but at inflated amounts, boosting income using one-time or unsustainable activities. This is often done through misleading classifications, shifting current expenses to a later period, so improperly capitalizing things such as your normal operating expenses, stretching out amortization, so we're amortizing too slowly, not writing down assets that have impaired value, failing to record expenses for uncollectible receivables and devalued investments, and then earnings management manipulations. This is often employed for a variety of reasons by managers because they have something at stake. So there's a bonus issue at stake or something along those lines. They may employ a variety of techniques to hide their expenses or losses, such as not recording an expense for a current transaction, failing to record an expense for a necessary accrual, or reversing past expenses, failing to record or reducing expenses by using aggressive accounting assumptions, or reducing expenses by releasing bogus reserves from previous charges. They may shift income to a later period by creating reserves. This often happens in conjunction with an acquisition and then releasing them into income in a later period. Improperly accounting for derivatives in order to smooth the income, and recording current period sales in a later period. They may shift future expenses to an earlier period by improperly writing off assets in a current period to avoid expenses in a future period, or improperly recording charges to establish reserves used later to reduce future expenses. There really is no limit to the amount, type, or cause of financial shenanigans. But what is that there is opportunity to do so on behalf of management. There are some cash flow shenanigans, such as recording some bogus cash flows from operations from a bank borrowing, boosting cash flows from operations by selling receivables before their collection date, or inflating cash flows from operations by faking the sale of receivables. They may shift operating cash flows to the investing section with boomerang transactions, improperly capitalizing normal operating costs, recording the purchase of inventory as an investing outflow. They may inflate their operating cash flow using acquisitions or their disposals, such as inheriting operating inflows in a normal business acquisition, acquiring contracts or customers rather than developing them internally, boosting cash flows from operations by creatively structuring the sale of a business. And they may boost operating cash flow using things that are unsustainable. Remember, the operating section is how we gauge whether management is efficiently and effectively utilizing the assets of an organization to generate earnings. And those earnings are for a variety of reasons. One could be reinvestment in the company, the other could be distribution to the shareholders. They can boost their operating cash flow from operations by paying their vendors more slowly. They can boost them by collecting from the customers more quickly. They can boost them by purchasing less inventory or with other one-time things that may occur. Because there's so many complexities that are related to the financial reporting. And there's really a lot of different generally accepted accounting principles that can be used. We have explanatory notes. Explanatory notes are an integral part of the financial statements. They provide detailed disclosure of information needed by the users wishing to gain a full understanding of the financial statements. They add an element of transparency. Some significant accounting policies that you need to remember there are. These are disclosed in the notes of the financial statements. They'll talk about the depreciation methods that might be used, inventory valuation methods used, what the basis of consolidation of subsidiaries are, reconciliation of taxes paid to the tax expense, costs of employee benefit plans, how goodwill and other intangible assets are being treated, earnings per share, of course, any stock options and stock purchase plans. These are all elements that would affect the decision making of one of the two crucial stakeholders, the investors and the creditors. Other disclosures you're likely to find, an accounting change. This is the change in the application of a principle that would have a material effect on the comparability of our current period financial statements with those of prior periods. If the firm has been involved in any type of a business combination, such as a merger, an acquisition, or a disposition, the transactions involved will be described and the effect on the financial statements will be explained. It's not unusual for a firm to be involved in litigation at any given point in time, results of which are often unknown when the financial statements are prepared. If the firm is denying liability in a lawsuit in which it is a defendant, it's appropriate to disclose the fact of the lawsuit to the readers of the financial statements. If subsequent to the balance sheet date, a significant event occurs that has a material impact on the balance sheet or the income statement, it's appropriate to provide explanation of the probable impact of that event on future financial statements. Remember, users of financial statements aren't just looking at what is happening now. They are forecasting to look to see what will be available for them in future periods. FASB encourages, but does not require that companies provide supplementary information on the effects of changing prices, such as inflation, in the notes of the financial statements. Really, in practice, very few companies will voluntarily do this. The required disclosure of segment, geographic, and major customer information is designed to allow the financial statement users to make judgments about the impact on the firm of factors that might influence specific lines of the business, geographic areas, or specific major customers. The impact of various depreciation methods, the units of production, declining balance, straight lines, sum of the year's digits, on reported net income must be disclosed. Disclosure of the method permits informed readers to make comparisons of companies in the same industry. They're more likely to be able to do an apples to apples by determining, are they just using a different depreciation method? FIFO, LIFO, and weighted average inventory valuation methods have an impact on the income statement and the balance sheet. The selection of the inventory valuation method influences reported net income and the inventory amount shown on the balance sheet. The basis of consolidation disclosures required that consolidated financial statements include data from substantially all subsidiary companies. A reconciliation of the statutory income tax rate with the effective tax rate is another required disclosure. GAAP is the set of rules for preparing financial statements. GAAP results in financial statement income tax expenses of a certain amount. The Internal Revenue Code, on the other hand, is a set of rules for preparing tax returns. IRS code results in income taxes payable. Income tax expense does not equal income tax payable. Hence, there is a need for a reconciliation for the users. Another key element is employee benefits. The cost of employee pension plans included as an expense in the income statement is disclosed. The projected benefit obligation, the present value of additional benefits related to projected pay increases. The accumulated benefit obligation, which is the present value of non-vested benefits at present pay levels, and the vested benefit obligation, which is the present value of benefits at present pay levels, are required by explanatory note disclosures. When a balance sheet contains intangible assets such as goodwill, which arises from a business acquisition, or trademarks, or copyrights, patents, any of the intangibles, the method of recognizing initial cost will be described. Any amortization or impairment in the value of the intangibles must be shown. There will be an earnings per share calculation, and an explanation of the calculation of earnings per share can include some details on the computation of how they derived at weighted average number of common shares outstanding, and the adjustments made to net income for preferred stock, stock options, and convertible securities. Speaking of stock options, a stock option plan is designed to encourage management to meet company goals by providing an incentive. The incentive may be measured by the difference between the exercise price per share and the market price per share. Stock purchase plans permit employees to purchase shares of a company's stock at a slight discount from the market value. The plans are designed to help employees become owners of the company. Some of the financial statements amounts will have some additional detail that is noted. So, for example, here we have plants, property, and equipment, and we have one big sum of $1.2 million, less accumulated depreciation of almost $500,000. There will additional note disclosure allows the companies to show the additional detail. How much of it is land, how much of it is building, how much of it is equipment, how much of it is furniture and fixtures. A lot of times when our financial statement amounts are reported in an aggregate amount like this, these note disclosures provide the users with additional detail that would allow them to ascertain whether or not they feel that the company and management are performing effectively and efficiently. Now, there may be other disclosures, such as any announcements of mergers and acquisitions. These are accounted for underneath a variety of different areas. If there is fair value, we need to make sure that that is being expressed as well. And contingencies are unfortunately a normal course of business. Contingencies are claims or rights to receive or pay assets whose existence is uncertain, but which may become valid eventually. Contingencies are also a required disclosure. Typical gain contingencies, such as the possible receipts of money from gifts or donations, refunds from the government, a tax dispute, pending court cases with probable favorable outcomes, They may be provided in note disclosure, but remember, we don't recognize these even if they are measurable. Loss contingencies, some of which will be represented in the financial statement numbers as a contingent liability, include possible payments that can come from litigation, the possible additional payments resulting from tax disputes, fines, penalties. There will also be additional notes disclosure explaining what these are derived from. Now, in the normal course of business, we end the year, say, December 31st. Sometimes there are subsequent events that may happen after the close of that year, but before we're actually issuing the financial statements. Now, this could have impact on current year financial statements. Some of these events in the subsequent periods may be required to be included in the current year statements. Other events may not actually impact this year's statements, but they might be disclosed in the notes because they're going to impact future period statements. Examples of these types of events include the issuance of a large amount of long-term debt, the restructuring of a long-term debt, the issuance of a large amount of capital stock, the sale of a significant part of the company's assets, or an agreement potentially to enter into a business combination. Now, by and large, inflation is just a normal part of life. Reporting the effects of inflation is considered a controversial and complex area of accounting. FASB encourages but doesn't require that companies provide supplementary information on the effects of changing prices in the notes of the financial statements. And in reality, very few companies do this. If the company experiences high rates of inflation in the future, efforts to reflect the impact of inflation directly in the financial statements are likely to be renewed. What you may find is the impact of the difference of pricing in specific geographic areas in the notes to the financial statements, the discussion of stability for an area, other areas where risk may be existing. Most large corporations operate in several lines of business and operate in many geographical areas. Segment information should include sales to unaffiliated customers, operating profit, capital expenditures, depreciation expense, and identifiable assets. Instead of an annual report, companies that are registered with the SEC file an annual Form 10-K. The Form 10-K includes most of the information that you would find on the company's annual report, which is typically available on their corporate website in the investing section. It must also comply with some additional SEC requirements. Company's management really does bear the ultimate responsibility of the financial statements. Thus, this is why CEOs and CFOs are required to attest to the information in the financial statements. The auditors who express an opinion on the fairness of the presentation of the financial statements are not the ones who bear the responsibility for the information that is presented in the financial statements and the notes. Corporations are required to include what's called the management discussion and analysis in their annual report. This is a section that talks about firms' activities for the year. It also includes some comments about the financial condition and the results of operation. It's kind of like the broad highlights. Now, most corporate annual reports contain a 5 or 10-year summary of some key financial data. This information often includes significant ratios and stock prices for its common stock. It's kind of a quick reference of what they feel are the most important things. Underneath the independent auditor's report, there's going to be a standard format. It's going to have 4 paragraphs. The introductory, the scope, the opinion, and the internal control effectiveness. The introductory paragraph describes the financial statements audited and states that management is responsible for the financial statements and that the auditor's task is to express an opinion about the financial statements. The scope paragraph describes the nature and extent of the audit process. Auditors wishes to obtain reasonable assurance that the financial statements are free from material misstatements. Doesn't mean there aren't any, just that they're not material as far as the auditor can determine. The opinion paragraph actually includes the auditor's opinion. This is where they express their opinion on the fairness of the financial presentation. Corporations want an unqualified report, but qualified reports have been issued. The internal control opinion paragraph refers to the company's internal controls. The auditors make reference to the internal control effectiveness and the opinion that accompanies the auditor's report as required by the Public Company Accounting Oversight Board. This is a dual-sided audit report. You can have one auditor who's only doing the internal controls. You can have one that is doing the financial statements. It depends upon the nature of how you structure this. In either case, they must be independent auditors, and this is really important and another subset of what SOX brought to the table. For companies that are not registered with the SEC and do not have publicly traded securities, accountants may provide a service by compiling financial statements. A compilation is presenting, in the form of financial statements, information that has been prepared by management. A compilation report does not have any assurance attached to it from the auditors about the fairness of this type of financial information.